In Q2, billionaire investor Bill Ackman bought shares of Nike. This was a new position in the Pershing Square Capital Management portfolio, which is worth over $10.4 billion. As you can see, Nike is just 2.2% of his portfolio. Now, just because he bought, the stock went up. Now, of course, since then, there were some other changes inside the company, new CEO, they reported earnings. We're going to discuss that later in this video. But remember, Bill also bought Netflix when it crashed. Well, the first part of the crash. He didn't hold on to Netflix for quite a long time. And since then, well, Netflix has recovered and then some. So just because we're seeing billionaire investors buy certain companies, certain stocks, especially beaten down ones, does not mean that it will always work out. Remember, you're buying a share of a certain company. If the company does not manage to turn things around, well, doesn't matter who bought shares of it, right? So let's discuss Nike in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So Nike stock this year is down 24.2%. In the last 3 years, it's down closer to 43%. Has a market cap of $123.3 billion and a forward PE of 28.8 times. It also pays out a small dividend with a dividend yield of 1.82%. Currently, the average analyst price target sits close to 11.4% higher than the price we're at today, at around $91.6. Now, if we're looking at some pricing metrics here, forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, we can see that Nike stock right now is lower than its 5-year mean on all of those. Price earnings to growth, though, is quite high. And that's the problem, right? That's the problem. Growth is decelerating. There is some uncertainty, even if we consider that Nike, the brand, is still Nike, the brand, right? It's still a worldwide known brand across the globe, pretty popular. Even if you add some value to the brand aspect, it's still quite expensive because of all the uncertainties. We don't know if the brand in the future will be as strong as it was in the past. For example, if we compare it to one of its major competitors right now, although a smaller company, this company is growing quite fast, and that's On Holdings. Now, if we look at On, it is more expensive on a forward PE basis. But if we look at price earnings to growth, On sits at 1.44, whereas Nike sits at 3.46. Yes, price to sales, EV to EBITDA, more expensive than Nike. But On is expected to grow faster than Nike and has been growing faster than Nike, not just On, all the other brands, especially when you look at the running category, they are growing faster than Nike and so probably taking some market share as well. Now, I do want to mention that despite all of that, I do want to mention that in the last 9.6 years, shares outstanding have come down, have decreased by 13.2%. Free cash flow per share has gone up throughout the years as well. So it's definitely not a complete disaster at Nike, but as investors in such a company, you would have expected them to do much better. And so what happens when you underperform for quite a long time? Well, usually leadership change. And this is the guy that comes in, Elliott Hill. This guy, back in 1988, started at Nike as an intern apparel sales representative. All those years later, he's now the incoming president and chief executive officer. That's quite a journey. Now, moving on to the Nike business. So close to 65% of its business, of the revenue, comes from footwear, 26.8% apparel, then you've got 4.3% in equipment, 4% Converse, and 0.1% global brand division revenue. If we look at what has happened in some geographies in the last couple of years, you can see the following pattern. We can see that Greater China, although we saw some uplift, and this was of course before the pandemic hit, lockdowns, etc., we've gone up, but since then it has come down and has stagnated for a couple of quarters. As for Europe, that has grown but also stagnated and actually came down in the last couple of quarters. North America has grown but here as well, since around Q1 2023, has stagnated and has come down as well. Zooming out a little bit, looking at total revenues, yes, since May 2015, total revenue has increased close to 73%. But, as you can see right here, the expectations are that revenue will decline 7.5% in the next fiscal years, and then increase 5.7% and 5.4% in the following 2 fiscal years. As for free cash flow, yes, since 2015, free cash flow has gone up, but it does seem like it could have done much better. Now, if we look at fiscal 2024, free cash flow $6.617 billion. But if you look at the expectations, what is going to happen in fiscal 25, 26, 27? In fiscal 25, it's only going to be $3.63 billion. Then, yes, improving gradually. So keep that in mind when we're going to do that reverse DCF. As for gross profit, operating margin, and gross profit margin, gross profit throughout the years has gone up, although, again, same story here. The last couple of quarters, it has stagnated a little bit. Gross profit margin has been higher before, right? We were closer to 46% before. Now we're back at 45%. The bottom line of the business is doing okay. Let's call it that, okay. If we look at operating margin, it seems like we have bottomed at around Q2, Q3 of 2023. Since then, it has gone up a little bit. But of course, like I said, back here in 2021, we were much higher. And so looking at the most recent quarter, we can see that revenue decreased 10%. Gross profit decreased 8%. If we look at net income, that's down 28% year over year in the most recent quarter. I know I said EPS was doing okay. I was talking about fiscal 24. Fiscal 24 EPS was still doing okay. Now, of course, for this quarter, starting fiscal 2025, we're starting with being down 26% year over year. Now, looking at the different regions here, North America overall is down 11%, Europe, Middle East, Africa down 12%, Greater China down 3%, and Asia Pacific and Latin America down 2%. Now, maybe you might say, okay, but with the recent announcements out of China stimulating the economy, could that help a company like Nike? Maybe that could be a good argument. And so, looking at the major overview, everything that was announced during that quarter that was talked about. So revenue declined as we've seen, traffic declined. Traffic decline were more significant than expected, particularly on Nike Digital and Greater China. Nike is actively reducing the proportion of its business driven by classic footwear franchises like Air Force One and Air Jordan 1 to create better balance. Nike saw growth in multiple sport dimensions like men's fitness, football, and running footwear. New footwear products drove strong double-digit revenue growth. Nike plans to significantly scale newness and innovation in the spring season with mid to high single-digit growth in footwear units. As for the investments, Nike is investing to fuel brand momentum, including major marketing campaigns and elevated retail experiences with partners. Revenue in Greater China declined 3%, with retail sales moderating across the industry. For Q2, Nike expects revenue to decline 8 to 10% and gross margin to decline around 150 basis points. As for guidance, Nike is withdrawing full-year guidance and postponing its investor day to allow the new CEO, Elliott Hill, to evaluate strategies. Nike sees signs of progress, but acknowledges it will take time to fully turn the business around. The focus is on driving newness and innovation, especially in running, to regain momentum. This might sound cheesy, but this is not a sprint, but a marathon. And so looking at what the analysts, what the market is expecting, we can of course go and look at Yahoo Finance for these expectations for EPS growth rates and stuff like that. Or you can have a clearer overview right here. And then we're going to calculate what that means for the stock. So EPS, that's expected to grow at around 14.4% on average. That's the growth rate here up until 2034. If we look at revenue, that's closer to 6%. That's the average growth rate. Knowing that, we can plug in the numbers. Free cash flow in the trailing 12 months sits at $7.266 billion. Now, if we put the terminal growth rate at 3.73%, discount rate 7.69%, how do you get that? You basically add these two numbers up right here, terminal growth rate plus the implied equity risk premium, you reach this number. So currently with an implied growth rate of 0% for Nike, based on these trailing 12 months free cash flow metrics, we've seen that it's going to be way less than that in fiscal 2025. So we're going to do that in just a second, but just basing ourselves on what has happened before, 0% implied growth rate, stock intrinsic value should be 15.22% higher than the price we're at today. Now, if we go and look at the number, what's expected, right? It's around $3.6 billion or so. That's what we've seen. Then I would think that the growth rate should be closer to 7%. Now, from what we've seen, revenue is expected to grow 6%. That's the average growth rate. And EPS is expected to be close to double that, right? So yeah, these are the two scenarios, just looking at free cash flow, what has happened and what might happen in the next fiscal year. Then purely looking at pricing and, well, forward PE, price to sales, playing around with those numbers. Right now, the current forward PE, 28.8 times, forward price to sales, 2.6 times. Now, as we've seen, the growth rate 14.4% for EPS and revenue 6%, which means in 2034, you have an EPS of $9.43. And if we'll put here a couple of scenarios for the forward PE, this is what you get. The, let's say, lowest scenario represents 74% upside from the price we're at today. And if we plug here a 33 forward PE, that's 284% upside from the price we're at today. And if it stays the same around that 28, that's 225% upside from the price you're at today. If we look at price to sales, revenue-wise, if we plug in the same number as we have today, 2.6, that represents 157% upside from the price we're at today. If we're basically cutting that in half, so just 1.3, that's 29% upside from the price we're at today. And then if we go and put in a higher premium, 3.7 times, that's 266% upside from the $81.14 that we're at today. But of course, as you know, this right here is a much better way to look at the stock, the reverse DCF. Of course, the big difference between free cash flow trailing 12 months and what's expected in the next 12 months, you have to take that into consideration with companies like Nike. Lots of other companies don't really have that big of a difference. Sometimes, yes, sometimes in the next 12 months is going to be actually higher. So you also have to play with that. But in this case, with what we've seen in the last 12 months, the implied growth rate is 0% and the stock should be higher. But if we're looking already what's happening or what's going to happen in fiscal 2025, then the implied growth rate sits closer to 7%. And so right now, looking at the stock, clear rejection here at the 200-day moving average. That was at around $89.7. Now we're also under the 50 and the 20-day moving average. So it's a bit in no man's land, but it does seem like we have bottomed right here at around $70, which happened at the start of August, which was also its lowest point since the 2020 crash. And previously, that was, well, the stock was at the same price it was back in 2018. Now we're closer to where we were here. We're actually a little bit under that, October 2022. Again, Nike, the brand, is huge, very, very popular. It's up to them to show the market that they can turn it around, that they can start to innovate again and get back or take maybe some market share from the Hokas, from the Ons, etc., etc. Do I think there is value in Nike? Yes, I think so. I think at around $80, like we've seen, I think there's definitely some value there. Still a strong company, pays a small dividend as well, and yeah, is expected to reaccelerate its growth in the coming fiscal years. So I would conclude by dipping your toes is the right strategy, not going all in if you are looking for such a stock in your portfolio. So that's about it for me in this video. If you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.